Hi, my name's Carin Weiss Krolikowski, and I'm a founder and accountant bookkeeper at firmTRAK Solutions, and I'm joined by my partner, Ryan Oltman, who's also a founder and partner at firmTRAK Solutions. Today, we ran across a really interesting article in the Journal of Accountancy on a tax court that ruled on the allowance of deductions on a ranch in Texas. Ryan, what were your thoughts on this article?
Yeah, so like you said, I mean, we as accountants find this article interesting. Your mileage may vary in other professions, but the reason why it's interesting is because it discusses this ranch that has a lot of different activities going on, including oil and gas, royalties, selling water to other farms in the oil industry, and as well as building and operating a cattle ranching operation, all on the same large plot of land. I think there's like multiple 100 acres here in Texas. And the summary of what happened here is the IRS came in and determined he deducted too many expenses, and a lot of what they do is look at your year-to-year trends, and they notice he had a ton of losses in this one year, so he got triggered for an audit. And it all kind of comes back to several factors, but the one we're going to talk about today here is this IRS regulation section 1.183, and this idea that the IRS has called the profit motive, and what that means as in general. And there are 9 factors that they determine in the court to determine a profit motive, but what it means general terms is if you start a side hustle, if you start a multifaceted layer operation like this rancher had, the IRS can actually come in and say that you don't have a profit motive and your expenses aren't valid because it's a hobby. You're just doing it to sink money to offset your legitimate revenue without a valid profit motive. And they evaluate this through several 9 factors in a court of law. And I'm just going to read them here from the article from the Journal of Accountancy, thoughts on the matter. But number 1, the manner in which the taxpayer carries on the activity. Number 2, the expertise of the taxpayer's advisors. Number 3, the time and effort expended by the taxpayer in carrying on the activity. Number 4, the expectation that assets used in the activity may appreciate in value. Number 5, the success of the taxpayer in carrying on similar activities. Number 6, the taxpayer's history of income or loss with respect to the activity. Number 7, the amount of occasional profits, if any. Number 8, the financial status of the taxpayer. And finally, number 9, whether elements of personal pleasure or recreation are involved. Carin, what is your kind of thoughts on the matter?
Well, I think it comes back to really business sense and having an understanding of business organizations. The one thing I think that this rancher had on his side more than anything was throughout the period in question in which he was audited, his wife handled the ranch's financial record keeping. And in doing so, she maintained documentation that the couple did provide to their CPA. The ranch operations used a dedicated bank account separate and apart. This is very key. Separate and apart from the family's personal household finances. So in other words, they were running it as a business. And so the court observed that the financial management demonstrated professional standards. So because it provided those professional standards, noting that they operated the ranch in a business manner. So therefore, their eventual ruling in this case came down to the fact that it was a profit-motivated entity, and that the deductions would be allowed under that premise.
Yeah, so it's very interesting. We talked in a video last week just a little bit about how bookkeeping can save you trouble down the road, and that's very a key point. And those 9 points I ran through, they're kind of fungible. Like, you have to come up with actual things you have done throughout the year to prove something, the manner in which the taxpayer carries on the activity. So that's just kind of vague in general, and it's going to rely on you and your mindset and your workflows day to day in order to prove that in a court of law. Now, this may never come up, but I think it's a good exercise to kind of think about. This particular ranch had multi-millions of dollars of revenue and losses, so obviously that's going to be more on the IRS's radar than somebody running a side hustle making a few thousand a year. But you can get to that point where you can build up 10,000, 5 figures, 6 figures in a side hustle, and those changes year to year are going to trigger IRS scrutiny. And it's just always a good thing to think about with this kind of little known, lesser known, I would say, the general public IRS evaluation of profit motive. So
I think that if you have any questions about setting up a business or a side hustle, I think it's important to remember the fundamentals of business, and that is, if you are profit motivated, which most of us are, you need to keep a separate bank account, separate records, apart from your family financial situation.
Okay, that's going to do it for us this week. Leave us a comment. Agree, disagree, let us know. We'll see you on the next one. Thanks.